get to trading times and what to buy and where our own markets are headed. Let's welcome our market master for the day, Tirthankar Patnaik, Director Institutional Research at Religare Capital Markets. Good morning, Tirthankar. Thank you very much for joining us. Okay, well, actually the overall view, the market has been balking at crossing that 7,800 mark. Some of the results have been deeply disappointing. The IIP just threw us off our optimism. What is the sense? You would still be confident and remain a buyer on dips?
See, I will remain a buyer on dips. Short answer, simply because the macro has probably bottomed out. We will not see things going worse from now. We'll see things improving. Of course, it's an extended recovery, and we are all the well better for that, because with this extended recovery is the only way we'll be able to get that other important point that we have, which is lowering inflation. If we to reach 6% by January 16, that's Governor Rajan's target, then necessarily growth will have to be weak. Growth will have to be disappointing. Earnings growth will have to be sub 20%. Revenue growth will have to be just about 10% or so. So that's the scenario we will expect, regardless of what the government does right now. And of course, we will expect the government to maintain fiscal discipline in all this. So I will still be a buyer on dips. Of course, the market will meander, and as it's been doing for some time right now.
What is the low for this market? Is that at least fixed at about 7,400? Or, all those worries that you are talking about, like more disinflation will have to happen. Do you think that will give people opportunities to buy at something around 7,000?
See, clearly there will be people, a lot of people, across segments, in the domestic institutional segment, in the retail segment, that have not really participated in this rally. The markets are, despite the drop that we've seen post-elections, or despite the flat-out patch we've seen post-elections, the markets are still up about 20%, and not too many people have really participated. And therefore, the understanding is that while the markets might consolidate, they will probably preclude a scenario of a sharp dip, barring something major in risk of happening globally. So in terms of the levels, 7,400 is what we are also looking at. That should be seen as a crucial level at which we will see buying coming in, either from the retail segment or the domestic institutional side, HNIs. So our near-term understanding on the market is about a range-bounded behavior between 7.4 and 7.8.
Tirthankar, hi, good morning. Actually, the last time when you spoke with us, you had indicated that you expect to see the Nifty at 8,000 by December. Is that still your Nifty target, or have you changed it a bit?
I very much remember that, Sonia. So basically, 8,000 by December is something we will hang on to. The point is, we will see another 3 to 4 months of inflation going down. Point is that we will probably see not too much of a dip globally. My base case is that when the wall of money finally disappears, when the Fed starts taking some decision on when to tighten, at that point we should not see a big destabilizing movement globally. That's our base case. In that scenario, capital flows to emerging markets will basically continue. And on that trajectory, if the earnings growth number for India for this year is about 15-16 odd %, there is very low probability of disappointing on that front. Maybe we will not see a higher number, but we should not see disappointment. So 8,000 in that sense is doable, is achievable.
Okay, let me revisit that argument you were making about, possibly more disinflation should come if that 6% inflation number should be reached. This opens up the possibility of a rate hike as well. Do you think that will not materially disturb the growth picture, disturb the earnings picture, or disturb the market performance?
See, it'll largely be sentiment. I mean, we would not rule out a hike, but hopefully we will not get to that particular scenario. The governor has been fairly adept at explaining his inflation viewpoint and how he actually plans to fight inflation going forward. So his statements are taken fairly well by the markets. So we would not expect a hike actually. And why am I saying only sentiments? Why am I saying explanations? Because a 25 basis point hike from here or a 25 basis point cut from here, more than the amount of more than the heavy lifting it might do on cost of funds, it will signal to the market an understanding of the RBI's view on inflation, whether the RBI is comfortable or the RBI is still worried. My read is that it will not come to that. The governor will be able to keep rates at these levels and of course reduce them as he feels like. He has already mentioned that we would like to win the war once. So from that perspective, I guess keeping rates at these levels should be all right. Of course, the credit deposit ratios, credit growth right now, deposit growth has to pick up. All those macro factors need to drive in over the next 2 to 3 quarters for the picture to emerge as a 6% number for January 16.
At least on because of this concern, do you expect Bank Nifty to be under the weather? Actually, there is a money control query on that issue. So let me get to the question. Raghavendra writes to us from Hyderabad, and he wants to know how investors should approach banking and financial stocks like PNB, HDFC, Yes Bank. That's quite a variety.
Well, see, we are neutral on financials from a model portfolio perspective. Yes, Indian economy is recovering, as I said, but the way we are playing it are, through sectors like cement, sectors like energy. On financials, we remain very cognizant of the asset quality issues at hand. And so, if you notice, most of the large PSU banks especially, have seen their best days around the elections. Post that, they have been basically coming off. So we would maintain that neutral view on financials. We are, of course, positive on private banks. The asset quality picture, as you very well know, differs markedly between the PSUs and the private banks, and we don't see that convergence happening anytime soon. Specifically on banks, PNB, I would not be a buyer. HDFC, we have long-term issues as to what happens with their developer loan portfolio. We don't expect the housing markets to do very well. We don't believe the merger talk that has been highlighted fairly aggressively in the last couple of weeks are likely to happen anytime soon. And on Yes Bank, of course, that is one of our picks in the mid-cap banking space.
Okay, by the way, the market is also picking up some pace now. So I think our viewers are listening to you, Tirthankar, because up more than 100 points on the Sensex. But the one sector that you have been extremely bullish on for the past many weeks and months has been cement. And if you look at the performance, I mean, you've got it right. Ultratech Cement is the biggest gainer this month, one of the biggest gainers this year. Would you still buy cement stocks at this juncture? And if yes, what are your top picks that you're looking at?
Well, Ultratech remains our pick. In terms of valuations, I take your point. I mean, typically, one would start getting a little bit uncomfortable on valuations post 10.5 times, EV EBITDA, which Ultratech is already past. Now, we get to bull case valuations, the stock could actually go all the way up to 14 times. But one would be, a little bit cautious there. One would not book profits. One would basically hold on at this point. Where we are getting incrementally positive on are the mid-cap space. Mid-cap cement, we have been pushing Sri Cement for quite a while. Added to that pack have been JK Lakshmi, JK Cement, Orient Paper, Birla Cement. So these are basically a slew of mid-cap cement picks that we are fairly positive on at this point, where we believe that 15 to 20% returns could be had in the next 12 months.
Okay, Tirthankar, the standout performance actually has come from the heavies. And over there, you have spoken of that 8,000 target in 2014. What would be the leaders in your model portfolio?
Okay, so remain positive on Ultra. The other stock that we like is ONGC. That's another stock that we really we are pushing on. It has done fairly well, but we would expect it to go much further. Other stocks that in the pharma space we have been overweight all through through the election rally, post the election rally also, regardless of the move away from defensives. So Sun and Lupin remain our picks. We are very positive on those fronts. So these are some of the stocks that we like. And the IT space, we had not downgraded the sector to underweight despite the elections. We remain neutral even at this point, so maintain that portfolio view. And amongst the large cap IT names, Infi, one stock that our analyst is getting increasingly positive on. He sees that the kind of valuation convergence that will happen for Infi versus large peers is going to take place over the next 2 to 3 quarters. the effect of having a new CEO is likely also going to pan out. The market is going to give the company that credence over the next 2 to 3 quarters. So that's another name that we're very positive on. ITC is another name. We did get HUVR wrong. The stock has done fairly well, but we had been playing this ITC versus HUVR trade. But we remain positive on ITC as well, even at this point.
Okay. From the mid-cap space, FMCG space, you've been bullish on Britannia for a while. That one reported very good set of numbers. But not just Britannia. There are other companies like Imami, Dabur, etc. that are doing quite well too. Would you still stick to Britannia, or would you look at other names?
Well, Britannia remains our pick, and the company's margins have been fairly nice. I mean, and the one worry that they've had, input cost inflation at about 9%, as the management pointed out to our analysts yesterday, is expected to peter off over the next couple of quarters. Milk inflation especially should start coming off a little bit, and that should, in our understanding, counteract the low A&P spends that the companies has had. 7.7 to 8% is what they've had. Even if the A&P spends actually go up, the company's volume growth of 10% and somewhat pricing increase that they've had should be able to tide over. We are looking at higher margins going forward. We are looking at a stock which is not very expensive at this point. It's about 24 times FY16, about 20 times FY17. Now that might appear expensive across the sectors, but in the consumer space, as you know, that's not very expensive. So this is one stock that we'll definitely push even at these points. About 15 to 20% returns are definitely there. Our target price is 1300, but the stock could go further. And amongst others, Imami and Dabur, both of them, Imami also had standout results. We would push for that stock as well. And the third name I would put out in the mid-cap space would be Bata. That's another stock which we believe could do better going forward.
A strong footing, is it? Okay, let me give you a clean slate. I won't restrict you to FMCG or anything, but in the mid-cap space, standout performers. Also, your view on this Adani Lanco thingy, will that give you any buy opportunities?
No, I'm not comfortable on either of the companies at this point. The whole infra space is one we have chosen to remain outside of. So maintain that view. L&T is the only stock that we pursue aggressively in that view. And even there, if the stock comes toward 1400 or so, is where we will be buyers. Not at. I think it's around 1500. That's where the stock is right now.
Fair point. Just to remind you of the other question, other mid-cap stocks that have impressed you besides the FMCGs?
Well, of course. We like Sonata. We like Gulf Oil. These are stocks that we have been pushing aggressively. Amongst the smaller capital goods names, we like Crompton Reeves, we like Cummins. So those are stocks that we have been pushing aggressively for a while right now. I also pointed out Yes Bank amongst the mid-cap names, banks. That's a stock that we like. Finolex Industries in the agri space is another company that we've been aggressively pushing.
Okay. Anything from the real estate space? I know this is a wrong time to be asking because yesterday we saw a big collapse in the real estate stocks. But there are some stocks that you guys have been, pushing, names like Shobha, Prestige, etc. Any fresh names, or would you still buy the names that I suggested?
See, Shobha and Prestige have been one stock, the set of stocks that we've really liked in the real estate space. The other stock I would like are, from a long-term perspective, Oberoi and Phoenix Mills. That's one more stock that's something that we like. Annuity business, Oberoi, because of its land bank. So those are stocks that we have been positive on. If there is a beta trade on large cap real estate, we have chosen to stay away from it. It's good in the time of time of news, but at this point it's essentially a time of performance, I would say. So real estate is not one space that we like, regardless of what kind of drop we had yesterday, really.
All right, Tirthankar, that's a bunch of stocks and issues that you have spoken to us about. Thank you very much. You still leave us feeling optimistic about the year ahead, at least what is left of the year, and the markets at this point in time in that same cheerful mood.